6, listen carefully, because what just happened was not a bad 2 days, not a freak headline, and not the market overreacting. $6. $6 trillion in U.S. stock market value disappeared in just 2 sessions, Thursday and Friday, after tariffs landed harder than Wall Street expected and retaliation fears detonated confidence. And if you think that number is the story, you're already behind. That number is the smoke. The story is the engine, the system underneath it, the machine that creates these events like clockwork on schedule with a consistency that feels supernatural, until you recognize the pattern. Here's the authority check most people ignore because it's not exciting until it is. The IMF's global debt database shows global debt sitting around $251 trillion, still above roughly 235% of world GDP. That's not trivia. That is the pressure rating stamped on the side of the engine. When debt is that large, the system becomes fragile in a specific way. It stops being resilient to shocks, and it becomes hypersensitive to policy mistakes, trade ruptures, credit tightening, because every asset price is sitting on top of leverage, refinancing schedules, and confidence. So when you hear $6 trillion vanished, don't hear and the market got scared. Hear this instead. The system hit its constraint limit. And once a system hits its constraint limit, it doesn't negotiate. It doesn't care about narratives. It doesn't care about patriotism. It doesn't care about what anyone believes. It only responds to math. Now here's the part that will decide whether you understand what's coming or you become collateral. The $6 trillion wipeout wasn't just loss. It was a message. A diagnostic test. A stress fracture showing you the structure is already late-stage sensitive, meaning the next shock doesn't need to be bigger. It only needs to land when the structure is more brittle. Stay with me, because in a few minutes, I'm going to do something most videos won't do. I'm going to show you a 4-stage pattern that repeats across empires, markets, and currencies, and then I'm going to run the United States through that pattern like a checklist. And when we're done, you won't be asking, will this get worse? Like it's a mood. You'll be asking the only question that matters. Which stage are we in, and what happens next? But first, you need to understand why the trigger almost doesn't matter. Tariffs, wars, rate spikes, bank failures, political fractures, an inflation print that won't die. Those are triggers. The trigger changes. The mechanism does not. Because when an economy runs on rising leverage, expanding valuations, and permanent confidence, the eventual break is not a possibility. It's a scheduled phase transition. Now let's define the mechanism. Not as vibes, not as politics, as a chronological pattern, 4 stages. So simple, it's terrifying. Stage 1 is the foundation. This is when a system builds credibility, strong growth, expanding trade, institutional trust, a currency the world wants, and a political promise that tomorrow will be better than today. In this stage, risk feels low because the system is young, productive, and still earning its dominance. Stage 2 is overexpansion. This is where the system confuses early success with permanent law. Debt rises faster than real output. Financial assets rise faster than wages. The system begins to solve structural problems by borrowing from the future. And eventually, the economy becomes less about producing and more about financing, less about building and more about bidding up the price of what already exists. Stage 3 is loss of control, what people call the crisis. But it's not one event. It's a sequence. Tightening liquidity, rising risk premiums, political desperation, policy thrashing. The system tries to maintain the illusion of stability while the underlying reality changes. This is when leaders do what leaders always do in late-stage systems. They reach for shortcuts, tariffs, controls, forced pivots, money printing, emergency measures, because the clean options are gone. And stage 4 is the inevitable outcome. This is where confidence breaks, not gradually, but suddenly. Market prices re-rate. Capital flees, credit contracts, liquidity vanishes. The population discovers that wealth was inflated, not earned. And the system pays the bill for years of overextension in a very short window. That is the pattern. Foundation. Overexpansion. Loss of control. Inevitable outcome. And here's the key. This pattern isn't American. It's universal. You can run it on empires, currencies, markets, or entire global orders. Now we prove it, not with opinions, with 3 historical case studies, each one following the same stages, so you can feel the mechanism, not just hear it. And as you listen, don't get lost in history. Listen for the structure. Because when you can see the structure, the present stops feeling confusing. Case study 1, post-World War I. Germany, the Weimar collapse. Start with the foundation. Germany before the war was a rising industrial power. Heavy industry, engineering, scientific leadership, a modern state. The system had credibility. It could borrow. It could mobilize. It had a currency people accepted. Now overexpansion, war finance. War rewires balance sheets. Germany, like other powers, financed enormous war costs through borrowing and monetary expansion. Then comes the post-war trap, the Treaty of Versailles and reparations. This is where the machine tightens. A state that has already leveraged itself for war is now forced to transfer value outward while rebuilding inward. That combination is financially toxic. Now loss of control. The government faces impossible choices: raise taxes dramatically, cut spending brutally, default, or print. In late-stage systems, leaders choose what preserves political survival in the short run. They print. And when they print into a damaged productive base while obligations remain fixed, the currency absorbs the shock. Then, the inevitable outcome: hyperinflation and currency collapse in the early 1920s. Money stops functioning as money. Savings are vaporized. Social trust breaks. And politics radicalizes because society experiences the sensation that reality has been stolen. Notice what matters. Not the morality, not the ideology. The stages, credibility, overextension, loss of control, break. And here's the deeper lesson. The collapse doesn't start when the currency collapses. It starts earlier, when obligations exceed capacity and the system tries to bridge the gap with financial engineering. Now, case study 2. The United States in the 1970s. Stagflation and the end of the old monetary era. Foundation first. After World War II, the U.S. sat at the center of global industry and finance. Bretton Woods establishes a system. The dollar is the anchor, linked to gold. Other currencies linked to the dollar. U.S. credibility is not just economic, it's institutional. The world holds dollars because the world trusts the architecture. Now overexpansion. Over time, U.S. spending commitments expand. Domestic programs, geopolitical commitments, war costs, while the dollar's gold link becomes increasingly strained. The system is trying to do two things at once: run global leadership and maintain a fixed anchor. That is a promise with a hidden contradiction. Now loss of control. In 1971, the Nixon administration ends the dollar's convertibility into gold. The Nixon shock. The anchor is removed. The system moves into a new era of fiat flexibility. This is where late-stage systems always go. When the constraint becomes painful, they remove the constraint. The political logic is immediate. The financial consequences are delayed and brutal. Then the inevitable outcome. Inflation accelerates through the decade, compounded by energy shocks. The economy experiences stagflation, weak growth with high inflation, something people were told shouldn't happen. And eventually, the system requires extreme tightening to restore credibility. That's why the Volcker era arrives with harsh interest rates. It's the reset required after overexpansion. Again, foundation, overexpansion, loss of control, outcome. Now case study 3, the 2007-09 global financial crisis, the modern template, foundation first. Decades of rising sophistication, deep capital markets, great moderation, confidence that central banks could smooth cycles. Credit is abundant. Risk feels engineered away. Now overexpansion. Household leverage rises. Housing becomes an engine. Banks and investors convert mortgages into tradable instruments, leverage stacks on leverage. The system confuses rising asset prices with rising prosperity. Financial engineering expands faster than real income. Now loss of control. Defaults rise. The system discovers it doesn't even know where the risk is. Interbank trust collapses. Liquidity dries up. One institution's solvency becomes everyone's question. Policymakers scramble. Emergency facilities, rescues, guarantees. The system tries to recreate confidence with announcements. Then the inevitable outcome: major failures, severe market drawdowns, recession, followed by years of extraordinary policy to stabilize the aftermath. The bill gets paid. And here's the important part. The crisis wasn't the cause. The crisis was the reveal. The cause was the overexpansion stage, the compounding leverage that required confidence to remain unbroken forever. Now take a breath, because here's where we apply it to the present. And I want you to feel how mechanical this is. We're going to run today's market event through the exact same 4 stages. And every time a stage matches, we mark it like a checklist. No drama, just confirmation. Foundation stage, US. Version. For years, the market has been trained, conditioned to believe in permanent liquidity, innovation-led growth, and policy backstops. Investors internalize one lesson: every shock will be managed, every dip will be supported, and risk assets will be rescued by some combination of central bank credibility, fiscal capacity, and global demand for U.S. assets. That foundation is real. It built the modern American equity premium, the belief that U.S. markets are the ultimate store of growth and safety. Capital concentrates. Indexing amplifies flows. The system becomes top-heavy, where a small number of mega companies carry enormous weight, and passive flows become structural momentum. Now ask yourself a retention question that most people avoid. If everyone is trained to buy dips, what happens when the dip isn't a dip? Hold that thought. We'll come back to it. Now overexpansion, US version. In an over-financialized system, valuation expansion becomes a substitute for real economic expansion. Wealth concentrates in assets. Consumer resilience becomes credit-driven. Corporate margins become sensitive to global supply chains and policy stability. And the economy becomes rate-sensitive because the structure is built on refinancing, leverage, and confidence. And we don't have to guess about the debt layer. The IMF shows global debt around $251 trillion, still above 135% of world GDP. That means the entire planet is operating with a thinner margin for error. In a world like that, shocks don't just hit one place. They ricochet through balance sheets, now loss of control, the trigger stage. This is where the needle hits the balloon. In this particular episode, the needle was policy shock and trade war fear, unexpectedly sweeping tariffs, retaliation dynamics, and the sudden repricing of global growth assumptions, reported as a tariff-driven rout that destroyed $6 trillion in market value in 2 days. Now listen closely, because this is the retention hinge, the point where viewers either get bored or they suddenly understand everything. Most people think the market fell because of tariffs. No, the market fell because tariffs changed the system's assumptions all at once. In a foundation stage system, tariffs are a challenge. In an overexpanded system, tariffs are an accelerant because the system is already priced for smooth global flows, stable margins, and predictable financing. So when you inject uncertainty into trade, you hit supply chains, earnings expectations, inflation assumptions, central bank reaction functions, risk premiums, all at the same time. That's why the drop didn't look normal. It looked like a trapdoor. And then stage 4, the inevitable outcome, the repricing, the sudden collapse in shareholder value, the violent, fast re-rating that reminds everyone that wealth is not a pile of cash. It's a confidence-based number created by marginal buyers. That's the event. $6 trillion gone in 2 days. Now watch what I'm about to do. I'm going to run the checklist stage by stage, like an engineer confirming failure points. And after each one, I'm going to say the word that matters, because this isn't theater, it's verification. Foundation. A long period where the market internalized the belief that liquidity and policy credibility would prevent deep, lasting damage. Check. Overexpansion. A system priced on leverage, concentrated market structure, and the assumption that global trade and capital flows remain stable. Check. Loss of control. A policy shock that forced investors to reprice growth, inflation, and retaliation risk instantly. Verified. Inevitable outcome. A sudden break in confidence producing historic speed and scale in market value destruction. Undeniable. Now here's the deeper revelation, the part that should make you sit up. A 2-day wipeout is not the event. It is the system telling you the system is already late-stage sensitive. In other words, if $6 trillion can vanish that fast from one shock, the structure is no longer solid. It's balanced, and balanced systems don't break in slow motion. They break when a threshold is crossed. So what thresholds matter now? I'm going to give you 3, and if you remember only these 3, you'll be ahead of most investors. Threshold 1, debt servicing and refinancing pressure. When debt is high, the cost of money becomes existential. Even small rate shifts can reprice entire asset classes. That's why global debt at $251 trillion isn't a background detail. It's the amplifier. Threshold 2, policy credibility. Late-stage systems lose the ability to make clean moves. Every decision creates a new problem. Tighten too much, and you trigger recession and defaults. Ease too much, and you reignite inflation and currency pressure. Policy becomes reactive instead of strategic. That's loss of control. Threshold 3, trade and geopolitical fragmentation. Markets can handle bad news. What they can't handle is uncertainty about the rules of the game, because the rules determine profit margins, supply chains, and capital allocation. Now, here's the psychological trap that destroys people right here, right at this stage. This time is different. They say it with different costumes. They call it American exceptionalism. U.S. markets always come back. They call it modern optimism. The system is smarter now. They call it tech salvation. Innovation makes the old rules irrelevant. But the pattern does not care. Innovation can lift productivity. It cannot repeal balance sheets. It cannot erase leverage. It cannot eliminate the cycle of overexpansion and reset. And the most dangerous belief in markets is not fear. Fear can be managed. The most dangerous belief is permanent safety. Now let's make this practical, because if you only walk away with prophecy, you will be entertained and still unprepared. Here's the actionable takeaway, derived straight from the pattern. When you recognize you are in a late-stage system, overexpansion moving into loss of control, you stop making decisions based on stories and start making decisions based on exposures. You ask, where am I exposed to liquidity drying up? Where am I exposed to refinancing costs? Where am I exposed to a sudden repricing of risk premiums? Where am I exposed to a trade shock, an earnings shock, or a policy shock? And then you do the most important thing retail investors almost never do. You position for fragility. Now, I'm not telling you to panic sell everything. I'm telling you to stop being structurally blind. Because in the loss of control stage, markets can whipsaw violently. Down on fear, up on hope, down again on reality. And the people who get destroyed are the ones who only know one mode, full risk on, until the machine forces full risk off at the worst possible time. So here's your warning, stated as cleanly as possible. The $6. $6 trillion wipeout wasn't random. It was the system confirming that it can no longer absorb shocks the way it used to. And if that's true, then the next stage is not calm. And the next stage is selection. The market selecting which sectors, which balance sheets, and which households can survive tighter conditions, and which cannot. And that leads to the final line you need to remember. The machine doesn't end with one crash. It ends with a new regime. Sometimes that regime is inflation and repression. Sometimes it's recession and deleveraging. Sometimes it's currency instability. Sometimes it's political rupture. But it's always the same structure. The system pays for overexpansion through a reset. So if you want the real advantage, if you want to see what most people can't, don't stare at the headlines. Study the stages. Because once you can identify the stage, you can forecast behavior. And here's the open loop I promised earlier, the one most people never think about. If everyone is trained to buy dips, then the market's most profitable moment becomes the moment when dips stop behaving like dips. That is when the crowd gets trapped. Because the crowd isn't positioned for a regime change. It's positioned for a repeat of the last decade. So do this right now, before the next headline, before the next shock, before the next surprise. That isn't a surprise. Subscribe, stay close, and watch the next video. Because in the next episode, I'm going to show you how the machine was built, how debt, trade policy, market structure, and central bank reaction functions locked the system into this path, and what the next stage usually looks like when history repeats. Because the people who survive a regime change are not the smartest. They're the ones who recognize the pattern before the crowd admitted it was real.